right? I think a lot of operators, they get focused on just hitting, I want 4,000 members, I want 5,000 members. But this really helps shift that focus to what is the value of each individual member. And in general, the stronger the lifetime value, the more attractive the membership base looks to a buyer. So buyers will look at labor not just as a cost line, but as just evidence of overall operational discipline and management quality. Well-run labor model signals that a business is scalable and controllable. Every operator should be focused on kind of margins, margin control, but more importantly, how do I better manage my labor to align it to demand, delivering this exceptional customer service, but doing so in a way where I'm not introducing too much bloat in my P&L. All right, want to transition next to the last section here. This really takes a step back from today's KPIs and look at the broader setup for car wash M&A over, the next 18 to 24 months. And this includes, trends in private capital, real estate, and just general macro conditions. So, first I want to start with, a little bit of a backdrop here in terms of the private equity landscape here. And, a lot of the consolidation, as mentioned earlier on in the presentation, has been driven by this growing interest amongst private equity sponsors. And, what I really want to highlight here, we're looking at this slide is, we're showing how many companies private equity firms currently own relative to the number of companies they have not yet sold, okay? So first and foremost, as we look at the top of this slide here, today there are over 13,000 U.S. private equity-backed companies in inventory. All right. As we look at those companies, over 62% have been held by more than 4 years. So to take a step back, why does this matter? How private equity operates, right? They'll raise money from their limited partners. They'll get committed capital. Over time, they deploy that capital. And what they need to do is they need to return that capital back to their limited partners. Most funds will have a life in, let's call it 10 to 12 years being that maximum threshold for a fund life, but they'll generally hold companies for a 5 to 7 year time horizon. So as I mentioned, one important metric that private equity manages to is this metric called distributions to paid-in capital. And that just simply measures how much cash and money they return back to their limited partners relative to the amount of money they put into their fund and commit to. So what's important here is, I mentioned that 5 to 7 year timeline here. That's typically, the time horizon in which private equity is looking at making an investment. As mentioned here on this slide, 62% of portfolio companies are held more than 4 years. In fact, 16% are now held in that 8 to 12 year mark here, which would be the outer edges of the fund life itself. That creates a little bit of a problem, especially when you look at the inventory to exit ratio today across private equity. If we look long term, the ratio of private equity portfolio companies to private equity companies that have been sold is historically about 6.9. Okay, so around 7 is a long-term average. Today, the inventory to exit ratio is 10.9x, so 11 times, which again states that there are 11 times as many portfolio companies for every liquidated portfolio company. So what this tells you is that there's a significant amount of inventory that needs to be liquidated in private equity today. This is a pretty significant development here, and you see this kind of balloon out as we've seen an overall, benign global M&A environment. Today, we're seeing private equity inventory building up at an extraordinary pace. But what's more important than that, as I've kind of highlighted here already in this slide, is that inventory is aging out. So today, there's roughly $3.8 trillion of unrealized private equity portfolio value. And 39% of those companies are now held for more than 5 years. And if we look at the average holding period at exit, it's 7 years, which is near all-time record highs. So this is telling you now that private equity is holding on to companies longer. And so it's not just that inventory is high, it's aging, right? This slide builds on the last one. It's not just that private equity owns a lot of companies. It's not that they've just been holding them, for longer. Private equities, they don't want to hold on to assets forever. At some point, they need liquidity for their limited partners. And a larger share of sponsor-backed companies are being held beyond that traditional hold period of 5 to 7 years. And what that does, that increases pressure on sponsors to find liquidity solutions, okay? The longer hold runs, the more likely that we see renewed deal activity and recaps and alternative exit structures. So what we're seeing here again is that we're seeing that the inventory of portfolio companies is growing. that inventory is aging out. And something that's really important as you think about this in context is not only do they have the need to create liquidity, there's also a tremendous amount of dry powder that still needs to be put to work. So today there's over $1.3 trillion of committed capital that is awaiting deployment. Okay. So this is a tremendous amount of dry powder in the buyout ecosystem. This slide shows the amount of money that private equity firms have already raised, but have not invested into new companies. And in simple terms, this is capital that's just sitting there on the sidelines looking for a home. Okay. So on one side of the equation, you have sponsors that have assets that they need to sell. They're growing in count. They're aging. And on the other side, they have money they still need to deploy. Okay, so a meaningful portion of that capital comes from older vintages that are under pressure to deploy. So this setup is really unusual, right? Sponsors need both exits and they need new deals. And that is a very favorable backdrop for sectors that still fit the buy box, right? And car washing today, based on what we're seeing in deal flow and activity, remains one of those sectors that fits squarely in the buy box. So, one important takeaway here is we think about the private equity sector today, that log jam of just pent up aging inventory, it's destined to break. And we're starting to see that here in real time, right? Mounting limited partner pressure to return capital started to break that log jam in the second half of 2025. In fact, as we look at kind of global buyout-backed exit value at 2025, we saw $717 billion worth of activity, which represents 47% growth year over year. So I think we're starting to see those early stages of that logjam breaking. We're starting to see a significant pickup in global M&A, especially coming off pretty low 2 years in 2023 and 2024, and really think that this is just the start of something that could be more substantial in the years ahead. Now, what does this mean for the car wash sector? This is really the synthesis slide, right? You have record dry powder, aging inventory, and a reopening exit market, which should theoretically create strong tailwinds for sponsor-led M&A in the car wash sector. As I just mentioned, the car wash sector sits squarely in that buy box because it offers recurring revenues, real estate optionality, the ability for multiple arbitrage by way of the levered roll-up strategy, and it's still, despite a tremendous amount of consolidation amongst the top 20, a highly fragmented industry. And there's also an element, a lot of groups talk about this. It is somewhat macro resilient, right? There are some parallels and some analogs that look to the gym industry during the financial crisis, which would suggest that backdrop of the membership base for, strong unlimited membership programs in the car wash sector provides a tremendous amount of resiliency through uncertain economic times. And I think we're starting to see some of that come to play in real time here as a consumer sitting here with all-time low sentiment. But as we think about this, again, the sector checks many of the boxes that institutional capital is looking for. And that doesn't mean that every asset gets a premium, but it means that the category remains highly relevant to capital allocators. It's important as you think about your business today, again, in a sector that's attractive for private equity institutional capital, really understanding the overall attractiveness of your business. All right, taking it one more step further in terms of what this means for the car wash sector here. Here we're doing is we're looking at the sponsor-backed platforms that are currently within this space, and we're looking at the timeline of the sponsor investment relative to their typical hold pattern here. Okay, so this slide shows where many car wash sponsors sit in their hold period today. And what's important to take away from this slide is that a number of platforms are already moving into that window where sponsors may start considering liquidity or recycling capital and different options to do so, right? So that creates future for M&A opportunity, both for sellers and for buyers alike, right? Some sponsors will look to exit, others will look to recapitalize and continue to grow. We're already starting to see some interesting activity kind of with different sponsor-backed platforms, recapping the business, bringing on some debt to offer some form of liquidity, potentially entertaining going into a continuation vehicle to extend the value creation cycle of that investment. So either way, holding period dynamics are likely to drive activity across the sector. So, as we look at our crystal ball, I think, we certainly expect to see some interesting movement, in particular, probably a fair amount of consolidation activity amongst the top 10, because what we're seeing here, again, as we look at this page, a lot of the top 10 sponsor-backed platforms are kind of aging out their investments. And I think they're going to be looking at all kinds of different options here to create some liquidity in their investments. On that topic, I already mentioned some of the tools in the toolbox here for different groups to provide liquidity. As hold periods extend, sponsors are using a broader toolkit today. That could be dividend recaps, which allow partial liquidity when leverage markets are open. And despite some pressure in private credit, anecdotally, we have had a number of conversations with some of the largest direct lenders in the space. They're still very eager to deploy capital in the car wash sector. So, while leverage markets are still fairly open here, dividend recaps offer a nice tool to kind of introduce some more leverage to performing businesses and redeploying that leverage back to limited partner pockets. Continuation vehicles, another option here. Talked about that. This allows a sponsor to hold, great assets that are performing for longer while still delivering liquidity options to their existing LPs. Minority recaps, this is becoming increasingly attractive, not just for sponsors, but for founders who want liquidity without a full exit. So it's really important to know kind of the toolkit, but more importantly, how different groups are thinking about capitalizing their business and really, the overall broadening of the menu for transaction types beyond just a simple sale of the business. All right, shifting gears a little bit here. This is a really important macro backdrop that's important to understand. Mentioned earlier on that the One Big Beautiful Bill Act, was a big source of, tailwinds for car wash M&A in the second half of 2025. Large reason for that, 2016, under the first Trump administration, they introduced the Jobs Act, which introduced this concept of bonus depreciation around CapEx activity. And again, car washing, in addition to having operational intensity, is capital intensive in nature. And what this allowed was a tax arbitrage for many investors in car wash real estate to immediately realize the expense of heavy CapEx and kind of equipment and just the general engineering of a facility to support that equipment. The issue was that bonus depreciation was phasing out over time. And what happened with the One Big Beautiful Bill Act in July of last year is it restored into perpetuity 100% bonus depreciation, actually took an expanded view of what's eligible for bonus depreciation. So the tax backdrop has become more supportive for sale-leaseback activity, particularly given the amount of wealth creation that's been in real estate markets, right? So the 1031 exchange concept, something that's highly important here and relevant. 1031 markets allow, owners of real estate to liquidate certain real estate investments and within a set window, roll those proceeds forward to avoid paying capital gains taxes on their gains in the real estate investment. You now layer in bonus depreciation, and car wash real estate has become a very attractive place for private capital to park money in a highly tax efficient manner. Okay. So after bonus depreciation return, we saw listing activity in car wash triple net real estate surging. So that tells you that the demand for tax advantage net leases, triple net leases in the car wash real estate sector remains strong, and it really unlocked a new pool of capital for car wash real estate, right? The leveraging or the sale-leaseback process in itself offered a very valuable source of off-balance sheet leverage for consolidators of car wash assets, right? So in other words, if you come in, you buy a car wash operation with the real estate at, let's say, 10 or 11x, you could blend down that multiple by selling the real estate to a triple net landlord and exchange that real estate for proceeds. And what you're doing now is you're taking the value of that real estate and exchanging that for lease or rent obligations now in the form of a triple net sale leaseback. So this is really important because, again, this has been a big funding source for car wash consolidation where groups come in, they buy, a car wash operations with real estate, and then they sell that real estate to help blend down that entry point, ultimately offering tremendous amount of off-balance sheet leverage. And the restoration of bonus depreciation by way of the One Big Beautiful Bill Act was a significant accelerate to car wash sale-leaseback activity. In fact, if we were to look at November 2025, we saw 289 car wash sale-leaseback marketing sheets compared to 100 in July, which represents 189% growth from July to November 2025, due again solely to the restoration of bonus depreciation. All right, this slide shows you how the market is pricing car wash real estate now. So the cap rate is just essentially the way that real estate investors measure valuation, right? So lower cap rates generally mean stronger pricing. So if you have a lower cap rate, assuming the same level of rents, that means that you have a higher valuation on the real estate. So just to make this a little bit more intuitive, let's say you have a piece of car wash real estate, and let's say that car wash real estate is paying rents to the tune of $200,000 a year. At a 7% cap rate, that car wash real estate is worth $2.8 million. Now let's assume that same level of rent at $200,000 at a 5% cap rate. That would imply that the car wash real estate is worth $4 million. And really, what we saw here is an interesting dynamic here. What this slide is showing is that the demand for car wash real estate remains strong enough to push pricing higher to a certain extent. But what's interesting is if you look at, the average monthly list price for car wash real estate from August 2025 through November 2025, while you've had, cap rates come down, you've seen that listing prices and valuations have come down. What that means is that owners of car wash real estate that have been participating in the sale-leaseback process have been a lot more diligent and prudent and disciplined with how much valuation that they put in that real estate, ultimately not overburdening their business with very expensive rents. So to me, I think that's encouraging, right? I think the big theme that I already mentioned here is that M&A activity and consolidation in this sector is already starting to represent discipline and a greater focus on fundamentals and operational excellence. This to me is encouraging because this continues to support the thesis that this next wave of consolidation is probably more for sustainable, healthy growth. And I think the handling of car wash real estate, again, with setting more appropriate levels of rents, not over leveraging the real estate and burdening the business with expensive rents, is to me a sign of health of discipline. And that's definitely something we're starting to see, not just necessarily in the cap rate environment, but in the average list price of car wash real estate in the sale-leaseback market. Looking at, brand premium by operator, lower cap rates are definitely a reflection of just the overall strength of the brand itself. Not all car wash real estate is priced equally. Stronger brands command tighter cap rates and better per site valuations. And this slide shows exactly that, right? Not all car wash real estate trades the same way. Better known, better positioned brands tend to get stronger pricing from real estate buyers. So in simple terms, brand quality, operator quality matters a lot in the real estate market too. That reflects tenant quality, credit perception, the growth profile of the business, and buyer confidence in the operator. And you see here that, the tightest cap rate that we've seen so far in the sale-leaseback market for car wash real estate is at about 5.7%. The widest is just over 7%. So about 150 basis points spread in brand quality as we think about cap rate spreads across some of the different operators that are participating in the sale-leaseback process. All right, so what does that mean for our outlook at Amplify Capital Group? We definitely expect to see the next 18 to 24 months being constructive for car wash M&A. Definitely expect to see volume move up, significantly supported by the need for sponsor exit, definitely founder fatigued, improved financing options, a little bit of FOMO, right? I think again, a lot of groups at some point in time were waiting for multiples to recover to those 2022 levels. And I think the realization now is that, there's a flurry of activity. You have some well-capitalized buyers in the space today. This may be a great opportunity and as better of a time as ever to participate in the sale of your business. We definitely expect multiples to remain bifurcated. Premium assets will command strong pricing, but definitely, subscale or underperforming assets will lag here. Again, so I think for those groups that are out there today throwing, mid-teens multiples out as being market comps, that's definitely not reality. We're seeing a clear bifurcation today, and there are definitely groups that are leaning in on quality platforms where there's an abundant white space. But the other side of it, you're not seeing the same enthusiasm if you don't have those markings to support your business. So, in general, the multiple environment, definitely expect that to be bifurcated. Expect the buyer mix to remain predominantly sponsor-led. I personally think that, we're going to start to see a lot more family offices look at this space. I cannot tell you, every week we're getting a number of inquiries from the family office community. And I think as we look at private equity, again, I mentioned private equity, they typically optimize holdings in their portfolio for 5 to 7 years. What's different about the family office segment is they're patient long-term capital, right? They're looking for cash flowing businesses that could sit in their portfolio of holdings for their family office. Definitely start to see, sponsor-led activity, but a different set of sponsors to include maybe more activity across family offices. I also definitely believe that we'll start to see more of a hybrid capital stack, which will include, more use of debt, different debt solutions, including direct lending facilities, unitranche facilities, more sale-leaseback activity to continue to pick up here, as well as some more minority equity. I think there have been a lot of the, blue chip private equity sponsors that have been circling the space. They believe in the thesis. but they've yet to really find the deal where they can really cut a sizable check given the size of some of these PE funds that are out there in the marketplace today. Could certainly envision to see some of these newer entrants come into play here as some of the older aging platforms are breaching the outer bounds of their holding period, and a minority recap with some fresh sponsor money coming into play here, could certainly foresee that being a big part of the 2026 and 2027 outlook. But overall, top operators growing, expect to see a lot of consolidation, that top 20 board here. But the overall, I think, view from an Amplify perspective is next 18 to 24 months compared to the previous 18 to 24 months, a lot more activity, a lot more consolidation, but underwriting models that are underpinned in discipline and extreme diligence and understanding kind of just the overall quality of the assets that they're buying. All right, so to wrap up here, I'd like to leave everybody that's listening with just really three key takeaways here. First, if you are considering a sale, the window is open, but it is certainly not permanently open. Second, if you're not looking for a sale, this is highly relevant. KPIs win the room, right? Tightening those core operating metrics ahead of a process directly enhances value. But again, even if you don't want to be involved in a process, right? If you're a seller, if you're an operator, we are all in the business of creating value. So it's really important to understand what good looks like and how do your KPIs trend to those metrics. I cannot tell you, despite how much growth we've seen in this industry, there's still that fundamental lack of understanding of what good looks like. So KPIs win the room. Third, process design matters more than most operators realize. I cannot tell you how important this is, guys. If you have a broker and advisor that's knocking your door saying, hey, I'm working on something in your market, would love to bolt it on together, that's not optimal. We're big believers running competitive bid process, big believers running a discrete confidential process, but at the same point, really understanding the buyer pool, the cap stack behind the buyers, and ultimately understanding which groups are likely to get to the finish line here. So the right buyer universe, messaging, and structure can materially change an outcome for a seller here. Really, the best time to prepare for a sale is well before you decide to launch the process. Really put in the legwork here to really optimally position your business and get maximal value. So with that, again, thank you for listening here. Hope you found some of these insights useful. Whether you're a buyer, seller, operator, or somebody's just curious about the car wash sector, please know that we're here to be a resource. We're always happy to provide the depth of resources and information that we have here at Amplify Capital Group. For any more information, please feel free to visit us at www.amplifycapgroup.com or always call our home office in Scottsdale, 480-581-1000. Thanks. Till the next time. It's been great. Talk to you soon.